Welcome back to the channel, and today we're going to take a closer look at Teladoc Health. It's one of those companies that have greatly benefited from the current pandemic. Sales are up and it seems like everything is going quite well. So why on earth has there been this huge correction with a price drop from almost $300 to just over $200 over the past weeks? Is this just an overreaction, or is there something to it? Well, stay tuned, because in this video you're going to find out all about it. Today's video is sponsored by no one, so let's get right to the segment. First, we're going to take a look at Teladoc's performance before the pandemic. Second, we'll analyze the company's last year results and their current situation. Third, we're going to talk about the massive acquisitions that Teladoc carried out in the last year. Fourth, we're going to look at some of the problems that Teladoc is facing right now. Fifth, we're going to get our crystal ball and take a peek into the future of Teladoc post-pandemic. And lastly, we're going to see some of the risks that Teladoc is facing, and I'll tell you what my conclusion is on whether you should buy the company's stock at this point of time. As you can see, we have a ram-packed schedule. So let's not waste any more time and jump right into the first segment. Unsurprisingly, Teladoc has indeed performed very well during the pandemic, but one should always ask themselves what the past looked like and what the future may hold. Now, if we look at the company's performance in the years before Corona, we can figure out whether the business was fueled exclusively by Corona or whether it was already going well before. With Teladoc, I have to say that even before the pandemic, the company recorded decent growth. In 2019, for example, sales climbed 32% to $553 million, which is really impressive. So it seems like the business was going well, even without the pandemic. So let's take a closer look at how Teladoc performed during the pandemic. In the past fiscal year, Teladoc's revenue nearly doubled. Yeah, you heard me right. Doubled from $550 million to over $1 billion. Now that sounds very good at first. However, the organic growth is actually less than it appears at a first glance. Teladoc made 2 acquisitions last year for an astronomical total of $19 billion. In order to classify this, you have to know that Teladoc, including its new subsidiaries, has a market value of only $31 billion at the moment. So this acquisition was a real chunk. And of course, Teladoc did not have that kind of money just laying around. Most of the costs were financed through a gigantic capital increase. As a result, the number of shares outstanding has risen from 91 to 152 million, and it seems that Teladoc does not want to stop diluting at this point. As can be seen from the annual report for 2020, preparations have already been made to issue up to 300 million more shares. So guys, if you want to see your ownership stake decrease massively without you trading any stock, then this might be the stock for you. Now I think at this point we need to take a closer look at these massive acquisitions that we just talked about. As you can probably imagine, Teladoc's future now pretty much depends on these acquisitions, especially the diabetic measuring device from Livongo. The purchase of Livongo cost $18.5 billion. No matter what standard you use, the price was extremely high, even for a large established company, which Teladoc is not. In the last quarter, in which Livongo presented its own figures, sales were $92 million. Revenue of around $300 million is expected for the 2020 fiscal year. On this basis, Teladoc purchased Livongo for a price-to-sales ratio of over 60. Now, how such a deal was able to be struck, I have no idea. But Teladoc's willingness to pay such excessive multiples goes to show that they value growth over everything. It remains to be seen whether this acquisition turns out to be a mistake, but Livongo better make them a ton of money soon. Let's get back to the business growth. At least that seemed really good, right? Well, on paper, yes. Teladoc did report a jump in sales from 550 million to over 1 billion. But, and there's always a but, a significant part of this growth exists thanks to the massive acquisitions we just talked about. And if we consider the dilution that has come along with it, sales growth per share is actually surprisingly low. Unfortunately, just from looking at their financials, it is not visible how high the organic growth of Teladoc really was. And unfortunately, Teladoc does not want to provide this information anywhere else. A coincidence? Well, before we end up exploring all sorts of suspicions and conspiracy theories, let's have a look at some of the things that we can see. Unfortunately, it does not get more pleasant from there. While sales rose from 550 million to over 1 billion in the previous year, be it organic or through acquisitions, the company's loss also exploded from 10 million to 49 million. So let me get this straight. In a year where everything became more digital due to social distancing, Teladoc recorded double the sales, which is good, but a 5-fold loss? I've got to say these proportions are rather unfavorable. One thing really puzzled me. The use of telemedicine in the United States more than quadrupled in the last year. So why hasn't Teladoc quadrupled its sales? Well, there can really only be one reason: competition. As an investor, I'm seriously concerned about the competition that is emerging, as it seems like they grabbed most of the cake. And yes, in fact, big insurers have discovered this area for themselves, have entered the market, and have established partnerships. Insurance giants United Health and Humana, for example, have taken hundreds of millions of dollars into their hands and are building their own services. This could mean serious trouble for Teladoc. For the fiscal year that just started, sales have jumped from $1 billion to almost $2 billion. A significant part of that can be traced back to the integration of Livongo. And again, the real question here is how high the actual organic growth is, especially per share, because the number of outstanding shares continues to rise. Nevertheless, many investors are likely to be convinced by this positive headline. It's irrational to a certain extent, but that's exactly what we've seen so many times in the past. One of the biggest risks plaguing Teladoc right now is the price risk. Telemedicine is still quite expensive and not really affordable for the masses. Last year, 46% of all US patients used telemedicine. A quarter of them no longer want to use it in the future. Even Teladoc itself expects a significant decline in dynamics over the course of the year. Revenue was expected to be $450 million for the first quarter and $2 billion for the full year. The growth rates from quarter to quarter would decrease noticeably in this scenario. Now, will investors still be willing to pay the current valuation, or will the price to sales ratio return to pre-pandemic levels of 10 to 12? At the moment, this would correspond to a price loss of more than 25%, even if sales rise to $2 billion. So we should really ask ourselves, what happens if Teladoc can't achieve its sales goals? In summary, the overall situation at Teladoc is highly complex and very difficult to assess right now. The company does have considerable potential, but I believe that the risks largely outweigh the positives. So my advice to you, if you want to get involved here, I'd recommend you work with a stop loss. I personally will stay away from this company for the foreseeable future until it becomes a bit more clear where this whole thing is headed. As always, thanks for watching and see you next time.